Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, Zinnia wealth.com. If it's time to talk about your retirement, we're here to listen and we're here to help. You can find us online at zinniawealth.com. All right, this is interesting. Kiplinger posted an article called The 5 Golden Rules of Retirement Planning. Follow these and you can have a successful retirement, so to speak. All right, so number one, there's a lot here in number one, but it says figure out your L's. Lifetime income, liquid savings, lowering risk and taxes, and legacy. Well, you could probably stop that list right there. That's pretty good, isn't it?
Yeah. So why is this the part of the number one part of the 5 golden rules to retirement planning? And in my opinion, when I hear lifetime income, that's people's favorite thing. When you get your Social Security checks, you're like, yes, that's going to come in every month. And then if you have lucky to have a pension, the people who have pensions are really, in my opinion, some of the happiest people, because that coupled with Social Security, that covers their bills probably and a lot of travel, right? So the lifetime income makes people giddy. And so there's other ways to get lifetime income out there as well, with just pouring a couple of bucks into them. So I think that is important to have that conversation. Liquid savings, liquidity, cash is king. And having liquidity in a portfolio is going to be very, very important. If you don't have a lifetime income, but you're pulling from savings that's not in the stock market, it's always there. It's going to show up. It doesn't change your lifestyle because we have some cash flow for a couple of years, especially if the market goes down. The other one was lower risk and taxes. That is a huge golden rule because you don't want to be in retirement and expecting income and all your money being in the market and your 401k turns to a 201k because now you can't touch your money. Mitts off, right? That's how you run out of money. So that's really important, and make sure you strategize for that without just doing one boring 60-40 strategy. You got to get a little diversified here, people. And it also talks about lowering taxes. So everybody, Randy, in the whole world, our goal is to have a high rate of return. So if you're in the stock market, you're like, okay, if we average 7% over the next 10 years, our money is going to double, right? And it's always about that interest and that rate of return. What if with tax planning, that 7% can actually go to 8%? So people forget the back end of the deal. Yes, being in a market, making money is important, but you can earn those percentage points by tax strategies and tax planning by 1%, 2%, 3%. So you could take that 7% to 10% just by aligning your tax strategy right and correctly. That's the key. So to me, there's where I shine the most. All this stuff we shine, but tax planning, there is no investment plan without a tax plan. And this is the truest statement I could ever say. And it can leave hundreds of thousands to millions of more dollars as a legacy and or to your surviving spouse. So it is critical that those conversations are happening. And last but not least was legacy. And legacy, what is your legacy? Is it your cars, your antique cars? Is it going to be your rental homes? Is it going to be your 401k? Do you need life insurance to leave a legacy because you're going to spend all your assets? So you have to start talking about that part. What do you want to do for a legacy? Does it go to your kids? Does it go to your siblings? Does it go to charities and churches? Because you do need to create the right trust for those types of legacies, in my opinion, to get things kind of dialed in so they do go to the places you want them to go after you've passed away. So figuring out the legacy, who's going to get it? When are they going to get it? Are we going to do trust fund type of legacy where, hey, I got a couple $1 million, and if I give one of my children half of that, they're going to go buy the red Ferrari I never received. So we need a special trust for that one. And then we have another child that would be very responsible. So we have to have those conversations because I see it go so many different ways. And so, this number one of the 5 golden rules, those are moving parts that cannot be missed as you're prepping for retirement.
It's kind of all encompassing there. So the L's: lifetime income, liquid savings, lowering risk, lowering taxes, and legacy. Those are all good, and we have to have all of that taken care of as we build our retirement plan. Now, the next one on the list is use all asset classes. Now, Sharice, you and I have talked about different sectors of the market, but this is different. This is where you put your money in and out of the market. So in asset classes, they say there's the market, there's the bank, and then there's the insurance companies. And I could also add to that, there's real estate. I think that's an asset class in itself as well. But spreading yourself out amongst those different places, that is a form of diversification, isn't it?
Yes. When you're in retirement, you should have a little bit of all that. And if you're sitting with a big bank or brokerage firm and you just have that market strategy, that 60-40 portfolio, you're missing out on a lot of other opportunities where you could potentially have a higher rate of return with lower risk by just seeking out what is out there, right? And markets is an asset class. Right? That's your equities, that's your bonds, that's a lot of things built into that, right? And the banks is a asset class, and it's a valuable asset class because banks have lots of types of investments, but the CDs for retirees has been very special because we've had a higher rate of return than we ever have before. So, and having that liquidity there is key, but having bank money and not making any money doesn't make sense to me. Insurance companies. We're talking about the insurance companies that offer fixed interest rates, like a 5-year fixed, maybe 5 or 6% a year for 5 years, whatever it may be right now. And they also have indexing strategies where you can invest in the S&P 500 and you don't have fees and you don't lose money and you only can make money when the S&P goes up. So those types of strategies are great, but they also provide that pension that maybe you never received at your employer. So you can put a couple of bucks into one of those private pension plans with the insurance company. We'll give you guaranteed income if you're looking for another income check. And then real estate. Real estate is key. What if we could get a check from that market money, that bank money, the insurance company money, the real estate bucket? Now you have all these income checks doing lots of different things. And then you sprinkle in a couple 1-year, 2-year notes that make money or can make money when the market goes up and or down potentially. And now you're just really spread out. Now you have leverage and now you have liquidity every year coming up and all these different angles. So I think diversification and asset allocation and the right specific asset classes to sprinkle it around make the most sense in a portfolio in retirement because it's getting harder than ever for certainty. And yes, the market's going up, but eventually it's going to go down, whenever that will be. So it's just, you can still make money in these other asset classes, and not all of our money should be making 10% a year, especially in retirement. That's just, overachiever.
You're listening to Retirement Coffee Talk with Sharice Rivers. We're going through Kiplinger's 5 golden rules of retirement. And the next one is avoid plans that depend on withdrawals. Now, we've talked about this a lot in the past. It's a very, very common do-it-yourself kind of thing to say, I've saved $1.5 million. Why do I need a financial advisor? I'll just peel money off the top and that'll be just fine for me. Withdrawing money is different than having your money make you money. And that's really kind of what they're talking about here, isn't it?
Yeah, I think a lot of people retire, they have the 401k and they feel like they have this, it's a plan, but a 401k is not a plan. And what a lot of people do is think of a kitchen table and you got this mound of money that you've saved and you open the kitchen door and the wrong wind comes in and blows out the back door. And now you have this mound of money that's shrinking and shrinking and shrinking. So being strategic with that withdrawal strategy by building income generating type of assets is the most clever thing you can come up with in retirement. And most people don't know how to do that. And therefore, what happens when that back door opens and, the dollar bills start flying out the door because we got this gust of wind that comes in that we weren't predicting. We find people either changing their lifestyle at home because now they're fearing that, okay, my amount of money is down to half. Now I can't spend my money. And it's because they don't have a plan. They just don't understand it. And we understand that. And this is why we are here. We are here to help you understand the math, the withdrawal strategy, the income strategy, and how to place all these types of income checks throughout the next 30 years of your retirement.
Number 4 on the list here is avoid plans that are based on probabilities. Now, I've heard you in the past say, we got this person from a 60% probability to a 95% probability that they wouldn't run out of money. But that's not really what they're saying here. They're basically saying don't base your success on the amount of money that you've saved. Base it on the strategies that you have to handle the troubles. And you and I talk about the troubles all the time. Inflation, taxes, market declines, all these different things that take place. Build your plan on that, not necessarily on the money.
Yeah, so there's different reports out there that says, okay, you have an 85% chance that you're going to survive retirement, not run out of money. They're basing it on probably the last 10 years. Very few people base it on the last 20 or 30 years. So, and we've done pretty well over the last 10 years, even with COVID, right? And you want to take those dollars, create a plan that is showing income going up with inflation, showing a pessimistic rate of return with all these different bucket strategies so that you can see actually where you land at a pessimistic viewpoint first, 30 years from now. To me, that's the best strategy to start with. And then start saying, hey, what if this happens? What if my husband goes into a nursing home before me and we are out of pocket, $400,000? How much does that derail our plan, right? We need to go get implants in our teeth. A lot of people don't plan for that, and a lot of them want that. What is the cost? What is the remedy? We have to talk about those types of things. What if an adult child says, hey, I need money for a down payment of a house, and hey, I'm needing $40,000 to $60,000. I don't know how many times I've seen that, if not higher. How does that affect? Do we see any of these things coming down? Let's test your retirement plan. And that's what we do. We stress test your retirement plan and we weigh it against all these different things that could happen based on what we've seen over the last 20 years. Therefore, we're probably going to see it again in the next 20 years, and we're probably going to see more and different things take place. So just making sure you're ready, you're prepped, you're tested, and you feel good and confident. The goal is that you enter retirement feeling confident, that there's transparency, and we've tested it among different angles and tested it against different market fluctuation points too.
The 5 golden rules of retirement planning. We've kind of gone through 4 here. Figure out your L's: lifetime income, liquid savings, lowering risk, lowering taxes, legacy, asset classes, moving your money around, having a little bit in each bucket: the market, the banks, the insurance companies, real estate. Avoid depending on withdrawals. And then this one that we just handled, make sure that you're not just basing your plan on how much you've saved. Base it on how your strategies are to handle the trouble that is ahead. And then the last one on the list here is your plan should be adjustable to meet your changing life. And how many times have you had a meeting, Charisse, when somebody came in and said, change your plans? This happened, that happened. Maybe it's a good thing that happened, or maybe it's a negative thing that happened. I mean, you got to be ready for it.
You do. I mean, I had an example. I had a young lady who retired, and she traveled the world and camped, and she had a good 3 years of retirement. She came back to me and said, Charisse, I'm going to be blind in 1 year.
Oh my gosh.
Talk about changing the house, changing everything, the care she's going to need in the house because she's a single woman. So there's always life-changing events that take place in people's lives. You don't know how many times I've retired people and a spouse passed away. Now we lose a Social Security. Sometimes we lose a pension, but we have already planned for what if somebody passes away in 5 years and we lose a Social Security or we lose a Social Security and pension, because not everybody passes on the pension, right? And you don't get a lump sum for that. And depending on how you set it up. So we want to test for that. And then I'll test 10 years out. What if one of you, depending on your age, go into a nursing home, and for the next 3 years, we are needing home health care or, nursing homes and all that kind of stuff. And we test for that. And then we also test for, okay, everything looks great. We've tested our hazards. Now with these hazards in place, let's test to see if we can take 20 or 40% more income than we ever intended. And we start to play that game of, okay, let's start at 20 grand. Oh, okay. So we take 20 grand for the next 10 years during our go-go years. It doesn't derail your portfolio. You still have a nice little legacy based on a 3% average rate of return, 30 years later. And so everything's just hypothetical, but when you get a written plan, and 1 out of 5 retirees get a written plan across the country, which is ridiculous because everybody in our office gets a written plan, and just showing people people sit back and relax for the first time in their lives. Like, wow, I get that. That's a real plan, Charisse. I can retire on that and not sweat bullets when the market goes up and down, right? Because there's a plan for if the market goes down. So there's a lot of life-changing events, a lot of market cycle events that change. There's COVID events, there's inflation. There could be hyperinflation. There's so many things. And we just want to make sure we're at least trying to be teed up for some of it as it comes our way.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.